SpaceX released its S1 IPO prospectus in late May 2026, and most analysts focused on Starlink's subscriber count and the $1.5 trillion asking valuation. They largely skipped past a number buried deeper in the document, $890 million. That is the total value of commercial transactions between Tesla and SpaceX and its subsidiary xAI since 2023. Two product lines make up that figure. SpaceX purchased $131 million in Cybertrucks from Tesla during 2025, at full manufacturer's suggested retail price. The larger portion is Megapack energy storage batteries, sold by Tesla to xAI for its AI data centers. When SpaceX absorbed xAI through a merger earlier this year, all of xAI's spending on Tesla batteries became SpaceX spending. That reclassification is consequential. Tesla is no longer just a supplier to a startup AI lab. Tesla is now a named supplier to the company preparing what may be the largest IPO in history. The supply relationship runs across 3 product categories and 3 legal entities that Musk controls. This is the part the consensus narrative missed. When analysts debate Tesla's valuation, they usually frame it around vehicle deliveries, full self-driving progress, and Optimus robot timelines. The S1 filing introduces a 4th frame, Tesla as infrastructure provider to SpaceX's AI and logistics operations. That frame was always implicitly true. The S1 made it explicitly visible and gave it a dollar value. Alphabet's situation is instructive here by contrast. Alphabet invested $900 million in SpaceX back in 2015 for a 7.4. SpaceX is targeting a public listing as early as June 12, 2026. The IPO is expected to raise up to $75 billion at a valuation of $1.5 trillion to $1.75 trillion. That would make it the largest IPO in history, surpassing Saudi Aramco's 2019 listing. Against this backdrop, Bloomberg and Reuters both reported in late May that SpaceX is exploring a potential pre-IPO merger with Tesla. 2 Nevada legal entities with the words merger sub in their names were formed on January 21, 2026, listing SpaceX's CFO as an officer. That is not rumor. That is a corporate filing. The conventional investor reaction to Tesla-SpaceX merger is straightforwardly positive. A unified Musk conglomerate. Starlink powering Tesla's autonomous fleet updates. Optimus robots built in Tesla factories for SpaceX Mars missions. Synergies written in headline form. But the actual merger math for existing Tesla shareholders is not straightforwardly positive. A pre-IPO merger requires Tesla to issue new shares to SpaceX's private shareholders in exchange for their SpaceX equity. That is dilution. Tesla shareholders would own a smaller percentage of a larger combined entity. The per-share outcome depends entirely on the exchange ratio, and that ratio has not been disclosed. Polymarket assigns only a 15% probability to a Tesla-SpaceX merger happening. The same markets assign a 74% probability to the SpaceX IPO occurring before year-end. That gap between 15% and 74% is not a reassurance. It is the core tension. If the IPO happens without a merger, Tesla shareholders lose the direct path to SpaceX equity ownership. They retain the $890 million commercial revenue relationship, but they hold no SpaceX shares. In that scenario, SpaceX's IPO creates a public reference price for a company Tesla supplies. The commercial relationship may be re-rated as strategically significant, but Tesla holders do not participate in SpaceX's market cap directly. If the merger happens before the IPO, the picture reverses. Tesla shareholders gain SpaceX exposure, but at an exchange ratio set by Musk-affiliated parties, before public price discovery has occurred. SpaceX's private shareholders and early investors have every structural incentive to negotiate an exchange ratio that favors them. Tesla's existing retail holders, who purchase shares as an EV and technology company, are now involuntarily exposed to an IPO pricing negotiation they have no role in. The leaning here is that the standalone IPO outcome, no merger, is structurally cleaner for near-term Tesla shareholders. A public SpaceX valuation creates a reference price for what the commercial dependency is worth in market terms. It resolves the binary without forcing a dilutive exchange. What would invalidate this leaning is not a single event but a persistent state, a protracted merger negotiation that keeps the exchange ratio uncertain for multiple months, holding TSLA in a discount to upside range while SpaceX's IPO roadshow dominates financial media and draws capital away from the EV sector more broadly. The antitrust dimension adds weight to that risk. A combined Tesla-SpaceX entity would hold dominant positions across defense-critical satellite infrastructure, commercial launch services, electric vehicle production, and AI compute. Regulatory review would extend the uncertainty window further. The hidden assumption most Tesla bulls are making right now is that Musk will not execute the merger. The S1 corporate filing evidence suggests that assumption needs a stated reason, not just a hope.
The SpaceX S1 contains a disclosure that received almost no coverage relative to its analytical significance. Anthropic, one of SpaceX's primary AI competitors and a company backed by Amazon and Google, is paying SpaceX $1.25 billion per month through May 2029 for access to SpaceX's AI compute infrastructure. That is $15 billion in annual revenue from a single tenant agreement. The compute in question is SpaceX's Colossus and Colossus II supercomputing clusters, which are the same data centers that Tesla's Megapack batteries power. Read that carefully. SpaceX built massive AI infrastructure using in part Tesla's energy storage products, and the primary revenue-generating tenant of that infrastructure is Anthropic. This is a multi-hop dependency chain that most SpaceX IPO coverage has not assembled. Tesla Megapack, SpaceX AI Data Center, Anthropic revenue, SpaceX AI segment revenue. The S1 acknowledges indirectly what this arrangement reveals. xAI's own Grok models have not yet filled the Colossus compute capacity organically. SpaceX is effectively renting spare capacity to one of its most formidable AI competitors because internal demand does not yet justify the infrastructure. That is a sign of infrastructure build-out ahead of monetization, not AI dominance. Why does this matter for Tesla shareholders specifically? Because Tesla's Megapack contracts with xAI and SpaceX are grounded in AI data center demand. If the Anthropic compute agreement expires in May 2029 and xAI has not filled that capacity with its own workloads, demand for Tesla's energy infrastructure from SpaceX softens. That is the downside tail that almost no analyst is pricing into Tesla's forward energy segment revenue. The constructive scenario runs in the opposite direction. Starlink generated $11.4 billion in connectivity revenue and $4.4 billion in operating income in 2025. Subscribers grew from 5 million to 10.3 million in 1 year. SpaceX commands approximately 80% of the commercial rocket launch market. If Starlink's average revenue per user grows into enterprise and defense customers, the highest margin tier, and if xAI's models become the anchor compute tenant at Colossus by 2027, SpaceX's AI segment revenue transitions from externally dependent to internally generated. In that world, the Megapack contracts expand, Tesla's energy segment grows in lockstep, and the SpaceX IPO validates the $1.5 trillion ask without relying on Anthropic as a revenue crutch. The number to watch in SpaceX's first 2 post-IPO quarters is not subscriber count. It is Starlink's average revenue per user and the percentage of Colossus capacity filled by xAI versus external tenants. Those 2 figures will confirm or deny whether Tesla's AI infrastructure exposure is a durable revenue stream or a contract-dependent placeholder. The $131 million in Cybertruck sales and the Megapack battery contracts disclosed in the S1 gave that question a dollar value for the first time. What happens to those contracts after the IPO is the forward checkpoint that Tesla holders now need to monitor.